asset securities. Today, we are delighted to have Mike Merrigan of Shadmore Advisors, founded in 2014. Shadmore is an independent consulting firm focused on investment manager operations and operational due diligence. Prior to founding Shadmore, Mike was a managing director at Gotex Fund Management, a fund of hedge funds with assets under management exceeding $5 billion, and a member of Gotex's investment committee. As global head of operational due diligence at Gotex, Mike led a team of 4 professionals based in the U.S., Europe, and Asia that conducted operational due diligence of over 150 funds per year across a variety of alternative investment strategies. Prior to his 4 years at Gotex, Mike implemented the first in-house operational due diligence program at General Motors Asset Management, which at the time was one of the world's largest pension funds with assets of under or rather exceeding $100 billion. Mike's, throughout his career, he's focused on alternative investments, and that goes back to 2002. He has worked as an investment due diligence analyst at HRJ Capital and Credit Suisse's hedge fund investment groups. He began his career working at Gabelli Asset Management. Before we introduce Mike, I do want to acknowledge and thank our sponsors, without whose support none of this would be possible. And of course, I'm referring to Alston Bird, Baker Tilly, Bloomberg, BNY Mellon, Deloitte, Ferential Systems, Grant Thornton, New Management Capital. Those are our platinum sponsors. Our gold sponsor is Benesch, and our not-for-profit sponsor, the Kaya Association. So without further ado, I would like to introduce Mike. And the title of today's discussion is The Evolution of Operational Due Diligence from the Investor's Perspective. So, Mike, before we get into the Q&A, are there any opening comments, observations you'd like to make in general?
Well, thanks very much for having me on today's call. I appreciate everyone calling in who's interested in the topic. We're coming up on the 10th anniversary in a few months of the failure of Lehman Brothers, Madoff, and I think that in many ways that was sort of the beginning of a renewed push 10 years ago to have a greater focus on operational due diligence from an investor's perspective, and find that the topic is still very timely, and enjoy discussing it with you.
So let's just kick things off with a high-level definition of operational due diligence. How does a practitioner like yourself define operational due diligence?
Sure. So operational due diligence is essentially the process whereby you're making an evaluation of the business side of an investment manager. So it's actually a huge subject topic area and very diverse. It's essentially everything outside of how investment ideas are generated and implemented. I would say in terms of the uber topics that we would typically cover, it would be things like organizational, how an organization is owned, how it's staffed, turnover. It would also include investment implementation from an operations perspective, such as trading, systems that are used to run the operations, valuations of holdings, compliance, business continuity, disaster recovery, cybersecurity, fund terms, audited financial statements related to funds, and cash controls. So that's a pretty sort of a mile-wide,
sure,
overview of everything.
And would you say that operational due diligence, or ODD as it's commonly referred to, is more than simply checking off boxes, that in fact it really is a method by which the operational competencies of the manager can be assessed in a thematic, disciplined way?
Yes, I think there was the sort of prerequisite for today's operational due diligence was probably in nature very much checklist oriented, and was often probably conducted by investment personnel. And I think over time that's certainly evolved into separate teams and even potentially separate external groups like Shadmore. And then what has it evolved into today is really, a trust but verify type of approach. And I think the danger for any operational due diligence practitioner is to turn into a reporter where you're sort of given information and you regurgitate that information and not necessarily question things and, address things like what are best practices vis-a-vis what other managers are doing and other people in the industry.
So it has a far more analytical quality to it than simply reporting the facts or data. So let me ask you something else, Mike. You had referred to the fact that we're coming up on the 10th anniversary. Imagine that, the 10th anniversary of the Lehman Brothers debacle. So in those 10 years, how has ODD changed? What themes can you put your finger on here in terms of change?
Well, the biggest thing, and maybe the most important from a high level, is that it's a huge factor in the overall weightings of an investment decision. So I think you could argue that 10 years ago, operational due diligence was a very small percentage in any total investment decision that either an individual made or a committee made. And I would argue today that that weighting is probably closer to 50%. And I think you could substantiate that thesis by the mere fact that many institutional investment platforms have assigned a veto power to operational due diligence groups where they could unilaterally decide not to allow an investment to go through despite a lot of confidence or conviction from the same investment team they work with. So it's changed the game in terms of how capital is raised, and it's also changed the game in terms of how investments are made. And there's been ripple effects from that in the sense that investments tend to probably take longer now to make. The due diligence process is an extended process. It's probably several weeks to maybe a few months, where it might have been a little bit sooner. There's more hurdles to jump through for the manager, and there's more time that needs to be spent.
So when we refer to investors, that covers a lot of territory, right? I mean, we have on one end of the spectrum the world's largest pension funds, right, that have a multi-generational, multi-asset class perspective. That's one end of the spectrum. Mm-hmm. At the other end of the spectrum, we have qualified investors, right? Folks that meet the minimum to participate in a private offering, right? Are there any, based on what you see, how does each group of investors approach due diligence differently? Like you mentioned the fact that, or the view that today ODD can account for up to 50% of the decision-making process. Does that change by investor group, investor class?
Sure. So I think it's safe to say that today, no rational person would invest in a commingled vehicle that had anything less than daily liquidity, and even then I would argue they'd probably do some due diligence, but without doing operational due diligence. In terms of the spectrum of investors, there's two considerations, I would say, that would inform how their process is going to differ. One is that the individual investor may just be investing their own capital, so there's probably a more level of risk that they're comfortable assuming because it's limited to their own personal asset risk. And that would be whether that person's a risky investor or not. As you move up in terms of larger investors and into institutions and businesses, then you're more likely to see that the people who are responsible for the investment process are actually investing assets on behalf of other people. And in those instances, those people also tend to have more resources. They have more human resources, more capital resources. And they also have very specific mandates as well in terms of what they're supposed to be following. So for all those reasons, the institutional investors probably have a more robust process than, say, the individuals. But I do think increasingly that we've even worked with individuals that I would qualify as high net worth individuals, and they are taking operations diligence more seriously than, say, they would have otherwise.
Okay. So getting back to, let's say, trends that you've observed over the last 10 years in the post-Lehman world, what factors do you see contributing to the shift the shift that has brought ODD to the fore as an important body of information to consider when making investment decisions?
Yeah, I think that I believe that I'd assign 4 specific factors to why ODD has become so significant. The first would be that there were a number of very high-profile frauds. We referenced Bernie Madoff at the beginning of this call. The second factor, I would argue, is what have been insufficient controls, and some of them have been actually at not only hedge funds and other investment managers, but also at very large global banks, where capital was lost that they didn't know was at risk. The third would be counterparty failures. So we referenced Lehman Brothers, and another well-known one is MF Global. And probably the fourth is the passage of the Dodd-Frank bill after 2008, a few years after 2008, which really changed the entire compliance protocol as it applied to investment managers, specifically to alternative investment managers.
So let's talk about fraud for a second. As you conduct ODD, what are some of the things that you look for to ensure that the manager has properly guarded against fraud taking place?
So I think fraud is always a big concern. So there's a few things I think, and these vary widely depending on the asset class, but I think we look very closely at verifying assets. So to the extent that we have a client that's investing in a fund and that fund has X amount of dollars, supposedly we verify those assets. We try to do that through an administrator, through counterparties directly. So there's the verification of the existence of the assets. Second would be through very close understanding of how cash is controlled, so cash couldn't be sent to third parties in a nefarious way. And I'd say another would be valuation, focusing, especially as you move away from, listed securities, level 1 type securities, where there may be a lot more subjectivity with respect to valuations. And I think those 3 areas are probably some of the areas that we, by focusing on those, there's been a lot of mitigation, I think, or at least incentive to try and commit fraud.
Okay. And what about counterparty failures? When you use the term counterparty, what do we mean by that?
Well, I think after 2008, there was, a recognition that you have to have diversification of counterparty risk. You have to understand the type of financing engagements that managers have, because many people, I think, found after 2008 that not all balances were, even if they were recovered, they took quite a long time to recover when they were with a failed counterparty. So understanding counterparty risk, whether that's hedging risk, margin risk, settlement risk, all those types of things, and whether there's a diversification significant enough of counterparties. These are all the different types of ways that I think counterparty risk has taken on new meaning. And we've seen it, I think, where managers are also proactively managing like they've never have before. They take counterparty risk very seriously, looking at the CDS of different counterparties that they're working with, monitoring those to decide how much capital they should have, with ongoing trades that they have or ongoing prime brokerage relationships with a given counterparty, and actively allocating that capital away where they perceive counterparty risk.
How important is having more than one prime broker? Because it sounds, as I listen to you define and use the word in sentences, it sounds like all roads, but by counterparty you really mean prime broker, principally.
Primarily, yes.
Okay. So here's my question. How important is it, from your standpoint as an ODD specialist, to see a manager have more than one prime brokerage relationship?
I think it's the ideal, but there are limits in terms of that you have to be a manager that's managing a certain size of capital before you can actually establish multiple prime brokerage relationships. So it would be very difficult for a manager that's, say, managing less than $100 million in a fund to have multiple prime brokerage relationships. There's been tremendous pressure on prime brokers, in terms of how their business is quantified and whether or not it's profitable or not, meets regulatory requirements to maintain a lot of different balances with managers that don't necessarily help their ratios. So it is preferable, but it's not always reasonable.
Understood. And you talked about Dodd-Frank. Could you illuminate us on that?
Yeah,
what is
sure.
Dodd-Frank? How did that affect?
So prior to the first quarter of 2012, many investment managers weren't registered with the SEC. I'd argue that quite a large number of them were, maybe as many as half or more. That created the need to register and to become, for people internally, to become very, very familiar with the regulatory regimes, which they weren't necessarily subject to such a high degree as they are today. It also created the need for the role of a chief compliance officer at a lot of firms that previously didn't have one. And those roles were difficult to fill, and now they're often shared with a person who's a senior operations person. But that role wasn't as widely held before, so that expertise has sort of grown up over the last few years, at least on the alternative side, where on the long-only side it's probably been there for a lot longer. So, and then obviously there's all the regulatory reporting requirements that have changed. So there's quite a lot there, and I think when we speak to managers, among their highest concerns for their business is the regulatory side of the business.
Yes.
And not so much that they haven't complied with it, is just that could there have been an oversight where they would be perceived to have not complied because of maybe a misunderstanding or an oversight, and then would that necessarily hamstring their business, while they're trying to work through an issue like that?
Yes. And on that point, let me introduce something else and get your response to it, your reaction to it. In previous calls here, monthly calls, we've talked about the growing concern over cybersecurity risks. So to what extent does your, and the fact that if, God forbid, someone was able to hack your account, you could be effectively shut down, yeah. Ransomware, et cetera, et cetera. So to what extent does your your purview of ODD now, is it focused on things like cybersecurity?
Yeah, cybersecurity today is probably the most prevalent topic within ODD. It's sort of white hot, if you will. I think the most interesting thing about cybersecurity is that when we meet with managers and we ask them whether or not they've had any cybersecurity incidents, often the response is that not that they're aware of. So
right.
That's somewhat informative in the sense that I think they're trying to make their best efforts, but that it's such a nefarious type of situation. The biggest thing I've learned about cybersecurity over the last few years is that I think it's really changed from a defensive game to an offensive game. So in the sense that a few years ago, I think cybersecurity was very focused on passwords and firewalls and sort of putting a moat around the castle, if you will.
Okay.
And I think today there's been sort of a better understanding or appreciation that a lot of the things that cause cybersecurity incidents are actually user-enabled and not intentionally. So with phishing expeditions and things like that, where you have someone who's sort of acting innocuously, but yet causes something to happen where they've allowed someone to get inside the network of their business. And I think there's been a lot more focus on, and this is what I was referring to in my reference to offensive, where training of employees about cybersecurity and phishing expeditions and sort of requests that have come in from other emails that approximate someone who's a supervisor but don't necessarily exactly match that person as a supervisor. And just like with counterparty failures and the frauds that we referenced earlier, I think this is a learning experience, and people are seeing, things that have happened to other groups in the industry and trying to learn from them and implement best practices. But it's a very evolving situation, and technology hasn't solved all of that problem. A lot of it is about user education.
Yes, I think unfortunately you're right about that. But let me ask you one more question along these lines. Corporate governance, and by that I mean the degree to which the fund is aligned with the interests of the investors. To what extent does this issue play into your or register in your ODD perspective?
Yeah, well, I think there were definitely lessons learned from 2008 that, the unimaginable can happen, where, very liquid assets can be held in funds that do decide to either suspend redemptions or use gates or things like that of that nature. So I think that put a higher focus on corporate governance, whereas investors probably hadn't paid as much attention to it. It was maybe a little bit of window dressing before that, but now I think there's a very, very big belief in corporate governance and external directors and qualifications of those directors, and making sure that, God forbid another situation like 2008 happens, that the people who are on the boards of those funds are effectively going to be investor advocates to treat the investors fairly, working with the investment manager. So I think there's a lot more focus now on who the directors are, what their qualifications are. A few years ago, there was a big interest in how many boards directors are serving on concurrently. That's still a bit of an interest, I'd say. Director compensation is an interest. So there's whether or not a board should have multiple external directors from the same director services firm is an argument about whether or not that's ideal versus all external directors being from unique director services firms.
Sure.
There's a whole bunch of discussions around all those things, and I wouldn't say that there's, in some of those subjects or those topics, that there's complete uniformity as to what would be best practice.
And it sounds as if directorships have become a much more important part of the whole ecosystem, so to speak.
Yeah, I think sometimes people ask for the minutes related to the director meetings. Are the directors meeting over the phone or in person? How frequently? What are the type of topics that they're covering? What sort of things are they responsible for approving or signing off on before something happens? How broad is their oversight? So the whole corporate governance piece is definitely something very important, especially if you go into a fund that you're entering into terms where you may be in the fund for quite a long time. You want to know that there's that additional oversight there, so it can provide
protection.
some remediation to any potential negative effects.
That makes sense. So, Mike, I think you've done a very good job of sort of summing up where we've come from, right? And we use, of course, Lehman Brothers as our starting point, so to speak, and that's 10 years ago. So where do you think we are today? What's the current state of affairs when it comes to ODD?
Well, I think the ODD bucket just keeps getting bigger in terms of what's in there. I think cybersecurity is now in there. I don't know that was in there 10 years ago, and there's just more and more things being sort of piled into that, and it's broadening the topic areas that need to be covered. I think where we are today in terms of the evolution is we've migrated from sort of a documentation perspective to a trust but verify, if you will. And I think testing and independent verification of things that are very important significance to the operations of the business is where we are today, and at a greater depth than sort of ever before. we referenced earlier the danger of being the reporter as opposed to the sort of the verifier.
Analyst.
Yeah, and making judgments. I mean, people want to know if what a specific manager is doing is in line with what best practices are across the industry, as opposed to just is it sufficient, you know. And so we increasingly are trying to engage in conversations with our clients where we're making a judgment call as to, in the specific instances, what that manager doing in a given topic area, not just sufficient, but is it the best they could do, given the people that work there, the capital that they manage, is that the optimal situation for them?
And you use the term best practices, right? Mm-hmm. Best practices based on what? How do you, so as you indicated earlier, and it's come through the course of the conversation with you, that there are so many different disciplines that ODD spans. So how do you track down best business practices across the spectrum? How do you?
Well, one of the nice things about this job is that we get to meet about 7 to 10 new people every week, and we get to meet several new managers every month. And over time, you start to get a sense for, you know, how those places are run and the systems they use, the technology they have, the processes, the operations, and things like that, the service providers they use. And you just start to learn more and more and more through those visits and through those relationships that you sort of initiate. And you, from the aggregate of all of those experiences, you start to draw upon, from not only a personal preference, but as all of these different businesses start to embrace specific types of structures, what is best practice, right? And best practice is a very evolving type of definition. It's not what was best practice 5 years ago. It's certainly not today, right? Which is actually very contrary to what I think a lot of people think of ODD as, is a very sort of boring, static type of situation, checklist-oriented. But in my mind, it's actually quite dynamic and fluid over time.
So are you saying that, let's say there are 10 disciplines for the sake of argument here. So we have enterprise technology. That would be one area that a manager would rely on. Either he's going to do it himself, or more than likely he will outsource that, right, to a company. Yeah. The manager is also likely to outsource brokerage and custody to someone. The manager is also going to outsource pricing to someone, right? So is it fair to say that across the spectrum of vendors, you have, at the very least, notes for each one of them that constitute what you consider to be baseline requirements?
Yeah, but I think one of the things that we try to do is, you know, we try not to say that, like, for example, there's still a tremendous amount of interest in emerging managers. And it would be sort of silly if we just tried to go to those emerging managers that are maybe under 500 million in total assets or under 100 million in total assets and say to them, you need to be doing X because that's what someone 5 times your size is doing. That would be a standard, I think, that would be a little bit unreasonable, extremely unreasonable. So one of our jobs is that we know what maybe we have our ideals, and then we know what we think is best, and we have enough contacts in the industry to sort of anonymously prove out whether or not what we think should be the case. So how do we apply them in a rational way to someone who's in their own circumstances?
Each individual set of circumstances. So these best practices really serve as a guide, and that ultimately a subjective decision is made.
Yeah, but with minimum standards in some circumstances. Okay. But a lot of times minimum circumstances, or minimum standards, I should say, aren't always particularly capital intensive. The ones that are capital intensive are when you're sort of trying to reach the ideal in a given situation or a different process, procedure, or system. So there's a big gap there.
So do you come up with a score?
We do. I mean, it's very difficult to come up with a quantitative score
or a range
for qualitative aspects, but we do for some of our clients, and some of them we don't. But yes, I mean, I think there's probably a handful of categories where we can. What gets tricky is if you are trying to create consistency among scoring, and then you have a long-short equity fund where you have probably very little to no valuation issues, and then you have maybe a distressed credit fund, and that may have a very robust valuation process, but it's a less straightforward process, and how do you score those two in a consistent way?
Right.
So it's the quantitative risk scoring is something everybody likes to have.
Sure.
In practice, it's somewhat difficult to actually complete it.
So it sounds like it's
an art more than a science.
I was going to say it's a blend of art and science, and maybe, as you say, and these are my words, not yours, correct me if I'm wrong, that it leans toward art.
It's an art, yeah.
Okay.
Yeah.
Very nice. So let me ask you this. In terms of where we are today, are there any other highlights that you think are worthy of note here?
Well, I think it's the ODD, so we've discussed how it's broadened in terms of its scope and importance. I think the other thing that's still very much evolving is the sort of ODD ink is now bleeding over into other asset classes, which I think is happening slowly in some cases, but is undoubtedly going to happen all uniformly. So I think it probably started out in hedge, and then it's now moved into PE and long only, and it's segregated mandates and all those types of things. And I think that that's going to be the way going forward, is that there are other types of investments which were maybe not used. ODD wasn't used the way it was for other types of investments, but I think now it's pretty much a process where it's equally applied. So that's definitely one aspect of it. I think another is, and this kind of lends itself to our earlier discussion about, you have the high net worth individual versus the big institution. Regardless of all of those, I think everyone is moving towards a risk-based approach where they'll essentially do ODD on managers at their inception prior to making their first investment, and then they've made an assessment, and now they have a sense for how does that manager compare to the other managers on their platform. And then with regard to ongoing monitoring, they're going to decide which managers. They're probably not going to assign the monitoring of them equally across all of them.
Okay.
So some might be a higher touch point versus others depending on their operational risk score, if you will. And I think that'll also be the case with how things are handled on an ongoing monitoring basis. So maybe you have a fund that you're very excited about, but you've given it a higher operational risk score. You might be visiting that manager or communicating with that manager about its operations more frequently than the one that you didn't have a high risk score towards.
Okay.
And so that, I think, is sort of, when you're dealing with limited resources in terms of how you're going to conduct ODD, those are the approaches that we see a lot of people taking. Just a couple of others probably worth mentioning is, technology is playing a bigger role. There's a number of groups that have come out with very interesting products that can screen ADVs very easily and look for, the delta changes year over year with each filing. So there are elements of technology that are coming into this. So that's also interesting. And I think there's just better technology platforms out there to sort of do ODD in terms of collecting information, documents, storing it, measuring the impact of different aspects of it.
So what are the consequences for a manager in not properly, adequately taking ODD seriously enough? What are the consequences?
Severe. There's just no question about it. I mean, I think it's playing out in reality, but it's also playing out in a number of different surveys that have been put out by prime brokerage groups and the banks and the custodians and things like that. I think the consequences are that for managers we're in an environment where I think managers generally feel like they're under some fee pressure, but that's kind of coupled with this other issue, which is that the due diligence process for someone to make an investment is now getting longer, and a lot of that has to do with operational due diligence. So you've got those two kind of compound problems. You also have the issues we referenced earlier in this, like compliance and cybersecurity and the regulatory regime, which has actually increased the operating costs of the manager. expenses, so they can't always be passed on.
And let me just go back to something you said a minute ago. It sounded like if they're not prepared, it can take longer for the ODD analysis to be conducted, right? But here's my question. If the manager is not crisp during that process, isn't that in and of itself a bit of a red flag? Why would I want to invest in a manager who isn't organized well enough to present this mission-critical information about their activities, their enterprise?
Yeah. Well, when I referenced earlier that the penalty could be severe, I think I believe that partially because it's a highly competitive industry, and if the fund has performance and risk in line with a lot of other peers, and they have preferential operational risk scores, let's say, it makes it very difficult for there to be a strong argument as to why you would move in the other direction. So that certainly can create some issues there. In terms of, do you get an innate sense of uncomfortability maybe? That could be part of it too, or not enough trust, things like that. Ultimately, I think it's a relationship that you're trying to develop, and if there is an interest from the manager side in terms of a genuine interest in taking concerns into consideration and working with you on those and trying to say that, yes, we think those are reasonable, and then I think if from our side, as I referenced earlier, we're not trying to dictate to them to spend $1 million on some kind of a software solution which is far outside of what would be reasonable or within their budget. I think you kind of end up meeting in the middle somewhere, and I think these are actual discussions that happen all the time, and I think fortunately for the most part you've got reasonable people on both sides of the aisle.
And let me ask you this, Mike, do you think that because of their size, small managers are disadvantaged almost by definition in this process because they may not have the resources to specialize, and because they can't specialize enough, it's a challenge to get the information together and to know about these different moving parts?
Yeah, it's a great question. I think there's two sides to it. One is that I think there's an enormous amount of academic research out there that continues to show that there are emerging managers can perform very well.
And more nimble.
Yes, and so there is tremendous interest in emerging managers, which is great for emerging managers. The flip side to that, though, is that emerging managers just tend to have less resources. They tend to have less human resources. There's less segregation of duties. There's more sharing of duties amongst individuals, and so that needs to be crafted very carefully, I think, in terms of that, communicating that there's been very serious and thoughtful consideration around how duties were assigned, how they're executed, given the lower amount of resources.
Sure.
But I do think, based on some of the surveys I've seen from the banking institutions over the last few years, it does seem, based on the percentages, that emerging managers in some cases have been disproportionately, vetoed in a sense, for operational issues. Not by a huge margin, but by a margin that's noticeable.
And do you think that intelligent outsourcing of some of these duties is a good solution?
Definitely. I think in some cases it makes sense with the appropriate oversight internally.
So for tasks and functions like compliance, maybe IT, they can be outsourced?
It depends, I guess. So outsourcing compliance, I would say, is, in terms of engaging a compliance consultant, I would say is a very common practice. But I think having someone internally still be the chief compliance officer is still the way to go. So they would leverage that external expertise, but not entirely outside and having an external compliance officer. That I would say no. So It depends on exactly how it's structured, but yeah.
Okay. So moving along here, typically, okay, where is there usually a disconnect between managers and the expectations of investors? Where is that? Where do these disconnects typically take place?
Yeah, I think managers are increasingly attuned to where the concerns of investors are. I think where the gap is that their assignment of the importance is still less than it is to the investor. So to say it more specifically, managers know that investors are worried about compliance and cybersecurity. But if you ask the investor how much are they worried about it, that number would probably be higher than the manager's expectation of what they think the investor's concern level is. So I think the managers are increasingly attuned to it, but I don't know that they always fully appreciate how concerned the investors are about it, because every manager has its own reputation and obviously wants to do a good job and put the best foot forward. But when looked at in aggregate in the industry, as people know that there are still issues randomly with different managers, the concerns are still there regardless of which manager they're looking at. And so that there is a little bit of a mismatch there, I think. But but I think, again, having reasonable people on both sides of the aisle where we can say, well, this is how we thought about this, and then the manager can say, well, this is what we think about this, and you kind of come to a conclusion. But I have to say, most of the managers, that we work with, they appreciate our feedback, right? The ones that are really serious about their business. I mean, I think that, and that is the majority of them. I think they actually are interested in our feedback, want to know what we're thinking, what we're seeing in other areas, not naming specific names, but just speaking in broad strokes about systems and things like that. And I think the best managers actually want to be challenged in the sense that we want to say to them, like, look, I think other people are doing this differently. You're doing it this way. Have you ever thought about doing this? And that should be a very sort of significant amount of dialogue, I think, right before an investment happens. And it does lead to changes sometimes, and then in other cases, the manager will say, when we reach a certain asset threshold, we're going to intend to do that. But there should be a very sort of prospective plan, I think, when it comes to those things.
So do you think it's important for managers to have business plans?
Yes, definitely, especially on the emerging side. So that I think investors get excited and also appreciate aspirational business plans. So, in the sense that, it doesn't have to be an outright promise, but we can say, sure, our goal is that this is what we're trying to do. We're trying to raise X amount of capital over the next period, months or years. And during that time, as we reach or come closer to hitting that milestone, we're not only going to benefit personally, but we're going to make investments back in the business, not only on the investment side, but on the operational side. And we're going to do that by hiring XYZ person at that level in that position, or we're going to implement XYZ system, or we're going to add, as you stated earlier, a second prime broker. And I think those type of aspirational plans are actually very helpful, because it also gives the practitioner milestones, so like, okay, we appreciate that they have expectations that the business should change over time. And again, I don't think we're trying to hold their feet to the fire on it, but over time, you would expect that some of those things are going to be implemented, and those are good follow-up conversations.
So if I'm hearing you right, a business plan really is a living, breathing document that needs to be refreshed from time to time as the facts and circumstances change. And if nothing else, it reflects not just the vision, but the thought process.
Yeah, I think that.
I mean, the fact that you have a section there about cybersecurity or disaster recovery or valuation techniques and pricing sources, et cetera, et cetera, et cetera. It would give the reader / potential investor or their gatekeeper a higher level of comfort, perhaps, that they've covered all bases or attempted to, at least.
Yeah, because I think your business is, you're asking someone to commit capital not just for today, but for a long period of time potentially, and even outside of their lockups, right? So that it'll keep staying in the fund and potentially growing organically, and also with additional subscriptions. So I think the thought is again, you're trying to develop this relationship with the manager, and over time, it's good to understand not only what the manager is today, but what their expectations are if they hit these sort of fundraising goals, how they're going to, what are the long-term goals for the operations side of the business. And I think those are very well received. And it also just makes you feel like I'm not the only person advocating this. I'm the manager's advocating it. The manager is advocating he's going to make changes to this business over time.
The manager is advocating it in their capacity as a business person.
Right.
So they're not just a portfolio manager, okay, but they understand, they have their arms around the business issues necessary to propel the portfolio forward, to keep it alive.
Yeah, and also that I think that sort of aspirational goals are they evidence, or certainly, and if not evidence, certainly communicate just a higher level of conviction.
Yes. So in the remaining time that we have, can you talk about your view of the future of ODD?
Sure.
What's in store?
Sure. So I think the biggest recognition I've made since going out with Shadmore and previously having worked with teams at institutions, but now working with a wider breadth of clients, I think the biggest realization I've had is, and I think this is very important for managers to know too, is that very similar to the way an investor has a point on that sort of Markowitz efficient frontier, and every investor has their own point for a variety of different reasons. I really, truly believe that, although it's much more difficult to quantify, that every investor is on some kind of operational risk continuum. And their ability to sort of accept a given level of operational risk is very, very different for every investor. So we can take an operational concern and talk to someone about it, person A, and then that person may say, oh, it's not even an issue. And we take it to person B, and that person may say, this is an issue that's so severe I don't even want to, move forward. So I think that the industry probably needs to have more of an appreciation for that. I think that everyone has their own operational risk profile, and it's hard to paint in broad strokes what's acceptable to everyone, because I think they're not always equal. And so we try to be very attuned to the idea of, what is this person's operational risk profile? Does this person have almost no operational risk tolerance, or do they have more operational risk? And I think that's the understanding of that and the appreciation for that is something that I'm trying to advocate for.
Okay.
And I think in addition to that, I'm finding just through Shadmore that you obviously have teams of people at big institutional allocators. They do ODD for those businesses, and then you have other groups, and they publish research reports. What I think is unique about what Shadmore is doing, I think is one of the reasons why people are interested in talking to us, is we're doing more of this co-source notion of operational due diligence, where it's really like a true consulting type of situation, where we're not just publishing operational risk reports on managers, but actually having conversations and putting customized programs together and customized reporting for clients on a one-off basis. And I'm finding that there's a lot of interest in that.
Well, this has been very interesting, and I see that we have a question in from the audience. The question is, what can managers do to ensure a smoother ODD process with an investor?
So I think our experiences are that the smoothest ODD reviews tend to be those where we've received an enormous amount of documentation in advance. So we're not on site asking lots of questions that take up lots of time, and then we have to rely on our own note-taking and then go back and reconfirm a lot of the things because we actually didn't get it firsthand. We kind of heard it, wrote it down,
okay.
Not sure. So I think transparency, but also just a lot of documentation about processes, procedures, and things like that, which we don't always get, to be honest with you, or maybe we don't get to the level of granularity. I find that makes the process very efficient. We're often in the office less. We feel confident about our assumptions because they were written down, and we can spend more time on sort of the verification that I mentioned earlier as opposed to just fact gathering.
Okay. And I just want to point out to members in the audience that at the bottom of the screen, there's a way for you to communicate with me directly, as well as the rest of the room. So if there are any questions that you might have, you can use that. So in the meantime, let me throw another question out from the audience. What is the most significant topic in ODD today?
It's been like this for a while, but I still have a high conviction in thinking it's cybersecurity.
Okay.
We spoke about it earlier. It's something that is there's not an easy solution to. It's sort of applying multiple levels of different types of defenses and offenses against it. It's something that's being battled in industries outside of the hedge fund and in the alternatives industry. It's governmental issues, and I think it's something that I think is just people are spending a lot of money on and a lot of focus on, and I think it's a concern of investors. And
yes.
And just with technology evolving as quickly as it is, again, trying to establish those best practices is going to be a very evolving thing. What was best practice in cybersecurity a few years ago, I'd say, is going to be very different 5 years from now.
Yes, and I think it's fair to say.
Very capital intensive.
Yeah, yes, and I think it's also fair to say that the challenge confronting managers with respect to cybersecurity can be felt across the economy. That they're not alone.
Yeah. That
anyone that's in business and that uses any degree of technology is potentially the subject of a cyber attack, which could be devastating to their not just their reputation, but their livelihood, their business as well.
Yeah, the FCC's issued guidance on it as well. I wouldn't say it was particularly detailed, but so there's a lot to take in there.
Yes. So I think that's all the time we have. I do want to thank Michael Merrigan of Shadmore Advisors for a very interesting conversation. I do appreciate your insights, Mike. It's good to work with you again. I'd like to draw everyone's attention to the slide in front of you. Michael was good enough to share his contact information, so you can see his telephone number as well as his email address, and we would certainly encourage you to reach out to Mike if you have any comments or questions. So once again, Michael Merrigan of Shadmore Advisors, thank you so much for your time and your insights. And folks, have a great.
Yeah, thank you, Bob, and thanks everyone for spending the time and listening on today's call. I hope it was helpful, and I hope you all have a great 4th of July.
Yes, and again, on behalf of the roundtable, I want to thank you, and thanks to the audience. Folks, have a great 4th, and we'll see you next month. Bye for now.